Hello everyone and welcome to our yet another discussion on the company accounts. We have looked at several issues including the categories of share capital. We have looked at the accounting of issue of shares, and in this session we are going to look at the other reserves that make up the equity component of a company. To start our discussion, we shall begin by looking at the share premium. On the slide, we are saying that premium means the difference between the issue price of a share and its par value. So what I want you to note is that shares have what we call an issue price, okay? Have what we call an issue price, and in most cases, the issue price is going to be different from the nominal value or par value or face value of the share. Now, the share premium is sometimes called the capital paid up in excess of par value. And of course, when a company is first incorporated or set up, the issue price of its shares will probably be the same as the par value, and therefore there would be no share premium at that point in time. As I mentioned, if a company continues to do well, especially if it is making profits, the market value of its shares will increase, but not the par value. Now, as the company continues to do well, the market value will tend to increase over and above the par value of our shares. So the difference between the market value and the par value of our shares is what you call the share premium. If these shares are sold, then the difference between the cash you have received and the par value on the new shares issued is transferred to the share premium account. In the next slide, I have an activity just to clearly explain this for your understanding. We have X company which issues 1,000 shillings 1,000 ordinary shares at 2.6 at 2,600 each. Now, if this is the scenario, then the 1,000 is the face value of these 1,000 shares. So if the ordinary shares are issued at 2,600, it will mean that these shares have been issued at a price that is above the par value. Now, what the company will receive on issue is cash of 2.6 million. But what we do to recognize this in our books of accounts, we shall debit the cash account or the cash book or the bank account, and then credit the share capital account with the nominal value of the 1,000 shares, which is 1 million. The excess which is above the nominal value is taken to the share premium account, which is our 1.6. So when you add through, you get our 2.6 million. So please note this right away as you continue in your career, as you continue in all the other discussions, especially finance, taxation, and audit, and all the others. You should appreciate the fact that the face value of shares is always constant. The face value of shares is what is statutory, what is registered, so that one does not change. Whatever goes above the par value, especially the price at the market, is taken to the share premium account. So this is one of those reserves that is included in the equity section of the company accounts. Next, we have the revaluation surplus. The revaluation surplus is another reserve account that is included in the equity section of the company. Now, the result of the upward revaluation of a non-current asset is what we call the revaluation surplus. The reserve is non-distributable as it represents unrealized profits on the revalued assets. This is another capital reserve. The relevant part of the revaluation surplus can only become realized if the asset in question is finally or eventually sold. In that way, you'll be able to realize the gain or that increase in the revaluation. We know that time and again assets keep on increasing value, especially land and buildings. These ones are known to increase in value. So if you find that at the end of 1 year or 2 years or 3 years, the value of your assets has increased over and above the cost, then that increase in the value, if you follow the revaluation model, is going to be taken to the revaluation surplus account. As we have mentioned on the slide, this surplus is not distributable the way you see the retained earnings. It's not distributable. You can only realize this if the land or the building is sold. Now, in the fourth bullet, we are saying that the revaluation surplus may fall. However, if the asset which had been previously revalued upwards suffers a fall in the value, in the next revaluation, that is what we call impairment loss. Now we are saying that in the fourth bullet, it is not uncommon for the value of assets to fall, and if the value of an asset falls, then we shall have a reduction in the revaluation surplus. We shall need to reduce the revaluation surplus by the previous increase before recognizing an impairment loss in profit or loss account. So this one, you'll be able to appreciate the treatment in International Accounting Standard 16, which we also have ahead of our discussions. So the fall in the value of a non-current asset is known as impairment loss, and this one is recognized as an expenditure in the profit or loss account. Alright, next we have the next reserve account, which is included in the equity of a company, which is retained earnings. And in the slide we are saying that retained earnings are profits earned by our company. These are profits earned by our company that are not appropriated to the shareholders as dividends. They are not paid out as taxes or transferred to any other reserve account, so they remain as retained earnings. Now, provided that a company is earning profits, this reserve account is generally expected to increase from year to year, as most of the companies do not distribute all their profits as dividends. Dividends can be paid from this account even if a loss is made in one particular year, because a dividend can be paid from the previous year's retained earnings. So it doesn't mean that if we have made a loss, we might not pay dividends. Yes, we can pay dividends out of the accumulated profits of the previous year. In the third bullet, we are saying that very occasionally we might come across a debit balance on the retained earnings account. This would indicate that the company has accumulated losses. It would indicate that the company has accumulated losses. So it is also normal and common that a company may have a negative retained earnings balance. That would mean that the company has been making losses for the years in question. Now, the other name that you might find in other reading materials or other content are revenue, reserve, and accumulated profits. So if you find that an account has been given this name, then it is as good as the retained earnings account. Okay, so we have been talking about dividends. So our next discussion, I'll just give a hint on the dividends. So what are dividends? On the side, we are saying that dividends are appropriations of profits after we have paid taxes and interest. These are appropriations of profits after we have paid our taxes. Shareholders who are also managers of their company will receive a salary as a manager. They are also entitled to a share of the profits that have been made by the company. These are rewards. Dividends are rewards for owning the company. In the third bullet, we are saying that many companies pay dividends in two major stages. Okay, in two major stages: mid-year, after half-year financial results, and this is what we call the interim dividend, and at the end of the year when we finalize the final account, and this is what we call the final dividend. Now, in most cases, the final dividend is proposed. In most cases, the final dividend is proposed. Again, we continue by saying on the following slide that the total dividend, therefore, is a sum of the interim dividend paid mid-year and the final dividend that is paid at the end of the year. However, not all companies by any means pay an interim dividend. In the second place, we are saying that at the end of the accounting year, the company's managers may have proposed the final dividend payment, but this will not yet have been paid. That means that the final dividend will not appear in our accounts, and we shall simply disclose that in the notes. So as you continue with company accounts, please take note of this. If you're given the interim or the final dividend that has been proposed, we do not recognize the proposed dividend in our accounts. We shall only recognize the dividend that has been paid. Alright, so with those reserves or reserve accounts, we can now go to the preparation of the statement of changes in equity. All these reserve accounts that we have talked about, the share capital, the share premium, the revaluation reserve, the retained earnings, the general reserve, are all included in the statement of changes in equity. So it is important for us to appreciate the format and the preparation of the statement of changes in equity. However, I should mention that the statement of changes in equity I am presenting here is a simplified version, because this is the first time you're seeing this, so I do not need to complicate it further. So with this simplified version, you will appreciate the fact that with the statement of changes in equity, you need to create a column for the share capital, where you capture the balances of share capital. You need to create a column for the share premium. You need to create a column for the revaluation surplus account. You need to create a column for the retained earnings. You need to create a column for the general reserve and a column for the total. Now, like any other element for the statement of financial position, you need to have a balance. So for all these accounts, you need to indicate the balance as at the beginning of the financial year. So I've put the balances here. Then you need to recognize the issue of shares, issue of share capital, which is going to be recognized under share capital and share premium if the issue has been made over and above the face value, which we have said is the par value. Then we shall recognize the dividends paid, and these are going to be paid out of the retained earnings, and that's why you see this XX is in brackets. Then we shall also recognize any increase in the value of our non-current assets, which is the revaluation, and as you can see, this is captured under the revaluation surplus. Then you will also need to recognize the profit for the year, that is the balance after payment of taxes, which is recognized under retained earnings. And then finally, you need to recognize any transfers either from reserve or to the reserve. So here I have indicated the transfer from retained earnings to the general reserve. As I mentioned in our presentation, that the company may put aside some money for cases of insolvency to meet those pressing obligations. So some money may be transferred to general reserve as part of the company's policy for such a purpose. So at the end of the day, after capturing all these figures, we now close off our statement of changes in equity, each column showing the balance as at the end of the financial year, depending on which financial year. Here I'm using an example of 31st of December 2022. So you need to give what you have for share capital at the end of the year, share premium at the end of the year, revaluation surplus at the end of the year, retained earnings at the end of the year, general reserve at the end of the year, and the total of all the equity accounts. So that marks the end of our discussion on the reserves. So the next session goes into the actual preparation of the statement of changes in equity, which is highly examinable. If you have any other question regarding this presentation, please leave your question in the comment section below this video. Otherwise, I wish you all the best. See you in our next session, where I'm going to demonstrate the preparation of the statement of changes in equity.